Hello and welcome to Fen Business. Today we're in conversation with Kailash Mittal from HDFC Life. Kailash, welcome on the show.
Thanks, Amol.
And I would like to learn a lot of things about actuarial, basically, how the actuaries craft the product insurance products these days. But before that, if you could give me an overview about life insurance industry, how is the industry doing right now today? How do you actually craft the policies? How actuaries actually look at the insurance products? If you could give the overview on that first.
Sure. Thanks, Amol. I think that's a right note to start on. So, if I were to look at the last 18 years, or maybe even the last 200, 300 odd years, right? So, insurance has been in existence for more than a couple of centuries in India. But there is a logical break if I were to take a pause at 2000 when the industry was opened. And then in 2009, 2010 when the industry went through a paradigm shift with the regulator actively getting involved in how the customers were being safeguarded and the interest protected. Now come to think of it, insurance at the core is nothing but managing risks. So what we as actuaries or we as life insurers do is just try and manage the risk. Now that risk could be mortality risk, risk could be morbidity, which is the health related risk. It could be a savings return related risk, that whether I'll earn 4% or 8% or 10% is the question. If I were to look at the last 18 odd years post opening up, I think somewhere in 2009, 2010, industry went through a different change altogether. Yes. And the way it shaped up was the customer interests were protected. Yes. Now, if you were to look at a typical product in 2003, 2004, your allocation charges were close to 40%, even 45%. Yes. Which in a way said that you give me $100 and $40 are lost. The fund value or the statement of units or the unit statement that will show you is only 60 and the remaining 40 is not there. From there, I think industry has gone through a long phase, and in today's environment there are policies in the market which have been issued wherein you give me 100 and you will see 100 on day one. Right? Now on the face of it you could say, how is it different from a mutual fund? And the answer to that could be, it's not different, it's exactly the same. But what we have to keep in mind is that there is an element of protection.
Yeah, and that is covered only with the insurance.
That is only there in an insurance. So, and then the classic example is, I can take a mutual fund and I can take a term proposition as well. But why do you want to take two policies? Let me bundle them under one umbrella and give it to you. Yeah. And you maintain the seamless migration flexibility to go from an equity fund to a cash fund at the other extreme, with no transaction charges, no tax implications, no short-term gains tax, and to couple it all, no long-term gain tax in today's environment, right? Okay. The classic case in point could be a couple of products which are there in the market, primarily available online as well as for the offline or the assisted sales. But the point being that the allocation charge is 0. In some instances, they give you 101 for every 100 rupee paid. The fund management charge is capped to 1.35%, which is way below a 2.25 that a mutual fund industry would charge. A typical mutual fund would charge 2.25 or maybe 1.75 at the best. But here it is capped to 135. Plus you have a 10 times cover on top, which makes it tax efficient. So that is how the evolution of a product offering has happened. Great. This is on the savings part. If I were to come on the protection part, now, I remember when I started my journey in life insurance, a typical 1 crore cover would cost you 35,000 per annum for a 30-year term. You punch it on any aggregator website today, or you even just Google around and try to find out, a typical 1 crore cover costs you around 9,000 to 10,000. So from a 35,000 level, it's come down to a 9,000, 10,000 level.
Probably more companies are coming with
it's just that more companies are coming and they are bringing you more and more offerings. And at the same time, 1 crore cover 10 years back was not heard of, even if the person was earning 1 crore. But today, the extent to which that entire process has become seamless, your medicals are so easy, so facilitative. You just walk into a center, they're done, reports are dispatched at the back end. So somewhere the entire space has kind of revolutionized.
So since you say that these are the major changes that happened in the last 18 years, so I will ask you specifically on the allocation charges. So what is that the companies are doing right now? Are they burning the cost on themselves, or the cost of allocation has been reduced at such a level because the competition is huge?
So there are, I think, 2-3 aspects. And before we jump into what has happened, let's just see what is that typical allocation charge constitute of, or what does it typically take care of. So one is your in-house expenditure. The second is, so my overhead, right? The support staff, the overheads, the life insurance industry setup, or the company's setup itself. The second is my cost of issuance. Issuance of that policy. And the third angle could be the amount of money that I remunerate my distributor with, right? So if I'm giving my distributor 20% or a 10% payout, I need to make that money good somewhere, and I take it as a charge from the end user, right? So these are the broad three buckets that would primarily feed into what goes into a premium allocation charge. Now, having said that, have companies become more efficient? The answer is yes. They've become more efficient in terms of either their policy admin systems or the way they're dealing. Plus, some companies have crossed the tipping point and have economies of scale. Such that they are able to spread their fixed expenses over a larger base. And hence the cost of acquisition for them is coming down. So a typical advisor or a typical sales manager who was probably overseeing only say 5 advisors would typically in today's environment be able to oversee 8 to 10 advisors.
So if I take a short question here, how do you tackle that challenge? I mean, reducing the cost and giving better returns to the investor as an actuary.
See, as an actuary, and this is something how I think about a product, I say the cake is only this big, right? And there are 3 stakeholders to it. You have the company, you have the distributor, and you have the policyholder. So these are the 3 stakeholders. And you always want to squeeze out your share of pie as long as possible or as wide as possible, but it will come at a cost of maybe the cake itself won't exist.
So then how the actuary add a cream to it, because everybody would like to have a cream.
Yes. So the way we look at it is we say that let us be reasonable, right? See, competition will force you. Now, are you as a company convinced about your business model? And if you're convinced about a business model, then you're saying, fine, what I'm doing is right. Am I being reasonable? Am I being fair? And when we actually look at it, we say that, am I being reasonable when I try and determine this particular charge, or am I being reasonable when I look at how I am positioning this product or what is the offering? At the same time, one thing that we always keep in mind is what is in it for the end customer. So what is my customer proposition? Is the customer proposition the fact that I want to just save 10,000 bucks a month? Or is the customer proposition that, boss, I want a cover of 5 crores or 2 crores or 1 crore? What is that customer proposition? What is that customer need that we are addressing? If we can do a need-based analysis, then maybe the customer would be willing to pay 5% extra for that convenience, for that seamlessness, and so on and so forth, right? As in, I'm digressing, but BOOKMYSHOW, when it started, even I was averse to going to it. But the advantage that BOOKMYSHOW gives you today is the choice of selecting your seat 3 days in advance or 2 days in advance instead of queuing up before it. For which if I pay 30 bucks extra, 40 bucks extra, I'm saying I'm okay with it. But when BOOKMYSHOW came, they had 0 convenience fee and they were finding it very difficult. But that is the proposition that they've brought to you.
Absolutely.
So is there a proposition that I as a life insurer bring it to the end user and say that, look, I'm making it seamless for you. So here is a term plan. You don't have to go for any medicals. It is straight through issuance. Just click it and it's yours.
But you are into the business of risk, and that is the major, business model. When you're trying to attract the policyholder by giving him some incentive, some relief, whether issuing the policy and everything, ultimately you're into the business of the risk.
Correct.
By any chance, is there a compromise on the risk? Because what is happening today is, and the first example that you give me sometime is, somebody is offering a 1 crore sum assured on the premium of 5,000 rupees. At the same time, if you look at the benchmark, who's the PSU company or a public sector company called LIC, is charging almost 15,000-20,000 rupees. So the question is how?
So the question then I would have it's a valid question, right? And the way I would look at it, I would say that, okay, where is that 20,000 rupees going? So if I were to take a pure protection plan, right? So I'll say there is 20,000 bucks of money on the table. Who is participating to what extent in this 20,000 rupees? So out of this 20,000 rupees, if I'm paying 5,000 to the distributor, I'm incurring another cost of issuance of say 3,000 or 4,000. I still have say 11,000 odd left to take care of my claims. But at the same time, if my payout to the distributor itself is 20,000 rupees, I don't have a really starting point. So that cost of acquisition, which was say 3,000, the fact of issuing a policy, sending it, can I digitize it? Can I make it more seamless? Can I reduce that such that it becomes only 500 rupees? So that extra 2,500 I'll pass to the customer.
True.
The other way is I'm incurring cost in setting up, branding. Can I go digital? Can I actually put it up on my website and say that, boss, you come to me instead of me coming to you as a supplier, as a manufacturer.
True.
If you come to my website, I'll give you it for a discount. Now, what are we ending up doing as a consequence? What we are saying is that the entire money or the money on the table, can I make more efficient use of it?
Okay.
And if I'm able to save some money, I'll pass on that benefit to the end user.
Okay, interesting. So
that's how you look at it. You say that, so what we do as actuaries is something called a premium utilization. And we say that every rupee that's coming in, boss, where is that 1 rupee going to? Is it going to the distributor? Is it going to my fund management expense? Is it going to acquiring that customer? Is it going towards issuing that contract? And then you have a broad landscape. You could look at it as a pie chart, you could look at it as a bar graph and say that, okay, this is where my money is going. Can I now do a focus study and say that, okay, where can I save some money? And that is the efficiency. You could call it economies of scale, you could call it efficiency, you could name it whatever. But that is effectively what you're doing. You're trying to spread that costs on a bigger base, and you're trying to bring down your per unit cost.
So thank you so much, Kailash.
Thanks
for
a lot.
talking to Business. Thank you so much for watching.